Welcome back to 7-Minute Options. Today I want to take a look at a cheap way to go long on any underlying. The example we're going to use is Square. And I have a few different positions on Square, and all of them are basically a cheap way to go long. And again, this is not a recommendation or investment advice by any stretch of the imagination. Square is a bit of a volatile company. It's a finance company. It's one of Jack Dorsey's creations. I mean, it could go very high or it could go very low. So this is highly speculative. But what I did here, let's take a look at this one down here. This looks like an iron condor, but it actually isn't, right? You got two puts, two calls. It's not. It's a put credit spread combined with a debit call spread. So what I did is I sold a put credit spread to finance buying a call debit spread. And one of the things I like to do when I go long on a stock, like if I think a stock is going to rise in value over the next several months, is to go far out in time. I've had this position on, you can see here, for 81 days, and it expires 241 days from now. So it's expiring in January of 2022. Even though it says Jan 21, that's actually January 21st of 2022. So it's still 241 days away. So let's take a look at how I put this together. So what I did is I sold this put credit spread. I sold the 150 strike and bought the 140 strike. So that's my risk. It's a $500 risk. That's the worst I can lose on this trade. If the stock collapses from its current price of 217, if it crashes all the way down here, then I potentially could lose $500, right? I bought a bull call spread, and that's a 330, 340 strike. So if Square goes to the moon and it goes up here, I can make, as you notice, this is 10 points wide. So I can make $1,000 on this one. And what happens if it stays in between these two strikes? And that is the likely case. Like, look, right now, the 150 short put is only a 12 delta, right? So that it's an 88% chance roughly that it's going to stay out of the money, which is good for me. On the upside though, there's it's a 17 delta. So there's like an 83% chance that I'm never going to reach this, amazing $1,000 area. And yeah, the 340 call, which is what I need to reach my max profit. I mean, that's even more unlikely. So chances are it's going to stay in between these two strikes. And I'm okay with it because the way I did it is I got more money for the put credit spread than I paid for the debit call spread, right? So the difference is actually positive. So if you look at this position, I actually got 35 credit for putting this on, right? So the put credit spread got me more money than the debit call spread. So that's $35. So if the stock stays in between these two strikes here, I get to keep my $35. Now, the downside is this is actually not something I do very often. I don't recommend this. This is one of my YOLO plays. And generally speaking, I only spend like 1 or 2% of my account on YOLO plays because generally speaking, they're terrible investments. And I'll show you why. Even though there's a good chance I'm not going to lose money on this, right? I'll just keep this 35 and I'll close it maybe a few weeks before for like $30 or something. So I'm not losing money on it. But because right now I'm only going to collect $35 in credit and I got to wait over 300 days to do it. Look at my theta. My theta is like almost zero. Yeah, so if you look at it right now, I got 35 credit when I put this on. Right now, this is trading for like 2 cents. So I could buy it back for 2 cents, keep 33. So in this case, I've already made this $35 or most of it. And so there's absolutely no more credit here, like net premium to collect, right? Look at the extrinsic value. Okay, it was a $2 second, now it's $5. So I'm going to be holding this for the next 240 days potentially with really almost no theta here. There's absolutely no time premium left. And so this is just tying up buying power, right? It's tying up roughly $500 of buying power, or 500 minus 35 in this case. The other thing that's annoying about it is because these are so far out in time, the market's very wide. So you can see the bid-ask spread here is 25 cents. The bid-ask spread here is 30 cents. Same thing on the upside. I got 30 cent wide market there. I got 20 cent there, which means every time one of these options is sold on the market, then it changes the price. So this price fluctuates wildly, right? Because this spread, like this position, has 4 of these options. And so it takes the basically, to determine the market value, it has to look at the midpoint of these 4. And with markets this wide, it fluctuates wildly, right? And when you got massive fluctuations in your position, then like minute by minute, this can change, and it changes a lot. And when you got positions where the market value changes wildly, it sends your daily P&L up and down all over the place. So it increases the volatility of your own portfolio, right? We're all aiming for a portfolio that is not very volatile, just kind of ratchets up a little bit each day. That's the ideal that we're all shooting for. And these types of YOLO bets, they just introduce a lot of volatility in your day-to-day P&L. So that's the position there in Square. And I got a couple other ones that we can look at in an upcoming video, but all 3 of these are YOLO plays. So I'm really hoping that Square is going to have a good year. Okay, there's one more thing I forgot to tell you guys about this position. There is also an additional way I can squeeze a little bit more money out of that Square YOLO spread, right? So as you saw here earlier, this is the put credit spread that we got. And I can close this out at any time, whether I do it today or tomorrow, and I can roll it down, right? So I have $5 of risk here. I can take the 170, 165, right? That would kind of reset me to the 20 delta range, which is kind of what I go for anyway. So as Square starts moving up, then I can once a month or so, or whenever I feel like it, I can just reset this to the 20 delta and collect a little bit. Today, this would give me $47, right? And my buying power would go up by 47 right away because I'm not taking on any more risk, right? I had $5 of risk here. I'm just taking that $5 risk and moving it to a higher strike, but it's still a $5 risk. So I would collect the credit that would go right against my buying power, and I would collect that. And I can do this every time there's a big up move in Square. Potentially I could do this. So if I can do this once or twice over the next 7 months while I have this position, I can collect another 100, maybe even more. So that's something to keep an eye on. But yeah, so that's it in a nutshell. Thanks.